A very warm greetings to all my viewers. Hope all of you had a great Diwali. So, in one of the forums I'm part of, there was a discussion on covered call. People were talking, is it a good strategy or a bad strategy? And that made me think about making this video because I had some learning myself based on the mistakes that I made. So, here I am sharing my learning and how I approach the covered call right now. First of all, I would like to point out that covered call, many times people think it's an easy strategy for making consistent additional income. I don't think it is an easy strategy. I think it is an involved strategy because in the market, there is no way you can make easy money. So that's number one. The second thing which I've seen people making mistake, that they are momentum traders. They will have the stock picks which are in momentum, and then they will write covered call on that. That's the biggest mistake even I have done in the past, but one should not be making that mistake at all. If your strategy is based on momentum, then you should ideally be staying away from covered call. However, if you're a very active trader who has a quick decision making capability, he is on the chart or has the algos, then potentially, even though you are a momentum trader, when those stocks get into some sort of a consolidation zone, you can potentially apply the strategy. With that, let me start the main content. I look at covered call in simple three steps. The first step is reviewing the chart. So this is not a strategy where I would say that at the end of the monthly expiry, next day after 1 hour, blindly go and create a covered call. It's not a blind strategy. And that is why I've named the title as Use Your Head, not just the holdings to write covered call. So it's very important to look at the underlying chart, which is step number one. If the chart is telling you that it is in a bullish momentum, please don't do covered call. Only if it is sideways to bearish, you can do the covered call. How do you look at it? I can talk about it. You may have your own strategy to determine whether the stock is bullish, bearish, or sideways. You can, by all means, go ahead and apply it. But please don't do this strategy when the stock or whatever underlying you are carrying is in bullish momentum. That's step number one. Once you have determined that it is in sideways to bearish, you can do covered call. And in that case, an important consideration is how do you go about selecting the strike? So there are a few ways. I will discuss some of them, and I will also show you what, based on my experience, I follow. And once you are in the trade, then you need to manage a trade. It is not a blind trade. It's not that because you are holding the underlying, come what may, you are not going to exit your position. You need to manage this trade like any other trade. Don't look at it as something which is very different. The only thing is, here you have an additional layer of assurance that you are holding the underlying. So you are not going to lose beyond a point. Okay. But it is not something which you have to necessarily carry till the expiry. I don't believe that's the case. So the third step is that you need to do your trade management the way you do trade management of any other trade. And then I will talk about a bit of improvisation. I'll leave that thought with you. I'll not get into too much of detail on that. So that is like, instead of creating a covered call where you have the underlying and then you're writing naked call, you create a credit call spread. So you write a call, but then you buy something after that, and you create a call spread rather than having a naked call against your underlying holdings. So this is the fundamental. Let me get onto the chart. Okay. So very quickly, I will give you two examples. Okay. And one of them is a stock which is in downturn, right? So let's look at Asian Paint. Right now, of course, it is showing some signs, but since I will get very easily the October option chart, I'm going to show you the option data, the data for October. Now, if you look at Asian Paints, right, from a very, very long time, from almost like last year, September, this stock is in a downturn. How do we know it is in the downturn? Obviously, it is making a lower high, lower low kind of structure. The red line is the 50 EMA, the green one is the 20 EMA. 20 is below 50. The stock is below both 20 EMA and 50 EMA. These are the slope. This is the first one is the slope of 50 EMA, and the second one is the slope of 20 EMA. So we can clearly see that on an hourly chart. Okay, the first thing is I like to look at the hourly chart. You should do a multi-time frame analysis. You should look at the daily chart and hourly chart, and maybe even weekly if required, depending on how active a trader you are. Since I'm an active trader, I prefer hourly chart both for the underlying and for the options. So this analysis I'm doing on the hourly chart. If you look at it uh, from the September 2025 itself, which is in the month of September, we were on a downtrend. Since I'm looking at October data, once the September expiry was over, let's say that 30th September, the September expiry was done. So we are now on the 1st of October. If you look at the 1st of October, the first candle was a bearish candle. But overall, if you look at the structure is a bearish structure. Now, this is an example. You may be having Asian Paints thinking that it will come back or the competition will lessen or whatever be your reason for holding Asian Paints. Assume that you are holding Asian Paints and you are now looking at this chart. The chart is telling you that it is not a bullish chart, but you're still holding. So might as well make some money out of that holding. And you are going to write a covered call on that. So this is meeting your consideration. Now, after you have seen this, what strike we should be selecting? So if you look at the end of the first hour on 1st of October, the closing price was 23.21. Okay. The way I prefer, of course, you can look at, maybe a 30 delta option, you could write it, or even 40 delta option in this particular case, because the stock has been in a bearish trend very, very clearly. But I prefer going to the daily chart in this case. And here's the daily chart. And here we are on the 1st of October, right? So the 1st of October is this particular candle. I prefer looking at the swing high on a daily chart. Now, the swing high, if we look here, this swing high is quite far, right? This swing high is about 2,600. So we may not get the proper premium at swing at 2,600 because the stock was at on 1st of October, it is trading at 23.35. Okay. So that was the closing, but it was around that 2,300. So we will look at the next swing high, okay, which was 25.40. So I will take the round figure 2,500. So basically, the way I'm describing is that to select my strike, I look at the swing high, the previous swing high on a daily time frame. For determining the stock, whether it is in bullish, bearish, or sideways, I look at an hourly time frame. So here we determine that Asian Paints is in a bearish trend. So we can write the covered call. To identify the stock, I looked at the swing high, which was at around 2,600, but that was quite far. So I looked at the next one, which is at 25.40. So I'm taking the round figure because these are, you need to consider the liquidity aspect for such stock options. So 2,500 call option is the strike which I'm selecting. So the first two steps are over. Once I select 2,500 call option, then I no longer focus so much on I no longer focus on the underlying chart. Okay. So in that case, I go to the call chart. So we have sold 2,500 Asian Paint call option for October expiry. So I'll open that chart. I'll go to TradingView and open 2,500 call option for Asian Paints. And this is again an hourly chart. And here the trade management is very simple. I follow a very simple thing. You can, the point I'm trying to make conceptually, you need to have an SL. Now, how do you determine an SL? If you have a good way to determine the SL on your option trades, please follow that. Else, you can do what I'm showing here, what I follow. So I put on hourly time frame, I put super trend with default setting 10.3, and I check if when I'm making this trade. So here I was making this trade on the 1st of October after the first day of the October series at 10:15. So I saw that the super trend was bearish. So this is telling me that I can go ahead with this trade and I can enter this trade. Once I've entered the trade, I trail my SL to the super trend. So my entry was at 9 rupees. Okay. Then we remained in the trade all the way till 14th of October. On 15th October, we see that the super trend is broken and it was at 4 rupee 15 paise. Once the super trend became bullish. When I say broken, that's not the right thing to use for super trend. Super trend turned from bearish to bullish as soon as the super trend, and this is not on the Asian Paint chart. Now we are on the option chart of the trade that we have taken. So we had sold 2500 call option. Before selling 2500 call option, we had checked that the super trend is bearish for this particular call option chart. Only then we had entered the trade. After entering the trade, every hour you can put the alert, and we will remain in the trade till the super trend remain bearish. As soon as the super trend turned bullish, we will exit the trade. In this particular example, we sold the call option at 9 rupees and we are exiting the call option at 4 rupees 15 paise. The trade is over. Okay. So this was the example where I've described all the 3 steps. The first thing is, if you're a momentum trader in general, stay away from it, but you want to still do it, then your stock has to be in bearish or sideways. In this example, obviously, this is not a momentum stock, so we got a perfect entry. Then, once we have determined that it is bearish or sideways, we are going to select the right strike by looking at the daily time frame chart and looking at the swing high. If it is too far, then we will take a judgment and look at the after that, whichever was the earlier swing high, and go to the liquid strike. Typically, the 100 or the 50 strikes are more liquid in the options, depending on what is the price of that particular stock. So we'll go to more round figure kind of strike because the liquidity is better. And we will select that strike. Then we will open the option chart of that particular strike. We will put the super trend. That's the only indicator we are going to put. We are going to enter the trade only if the super trend is bearish. And we will trail to the super trend on hourly chart. As soon as the super trend becomes bullish, we are going to exit that trade. Okay. So I've described everything. Now let me take an example. Let's say you are a very active trader. You are having a momentum strategy. And despite me telling or anyone telling you that if you are following momentum, please don't do covered call, you still are hell bent on doing covered call because you can take very quick decision. You are doing it as full time. You are in front of your screen, etc., etc. So I'm giving you one more example, and that example is of MCX. So MCX, as we know, MCX is on an uptrend, right? It is one of the momentum stock for a while. So we again put the hourly chart. Now we are on the MCX chart. We are looking at 1st of October. Okay. Now, when we are looking at 1st of October, we can clearly see that the stock is on a uptrend, right? The price is above both the EMAs. Then we are seeing that the slope of the EMA is also bullish. So we should not be making a covered call here. However, if you look towards your left, you can see that the stock was in a consolidation pattern, right? So if you're again hell-bent on doing it, and you say strictly that at 10:15 itself on 1st of October, I had to take it. 10:15, the stock was still a bit below rather on an hourly time frame, 20 and 50 EMA. Fine. You can try this out. Let's see what happens in this case. So at 10:15, MCX was trading at 7,800 rupees. Okay. And we say that for the shorter time frame, we are seeing that the stock is sideways. It is no longer having a very strong bullish momentum. So I want to attempt a covered call. Again, not a good practice, but I'm just showing you for the sake of showing what happens in this particular case. So I will now select the strike. How do I select the strike? I go to the day chart. Okay. On 1st of October. Okay, so here we are. This is the candle here, 1st of October, 7811. So we look at what was the previous swing high. So we see this swing high was at 8,400. If I look at on a daily time frame, 8,422 is the swing high. So in this case, I'm going to select 8,500 because that's a nice 500 multiple and liquid strike. I'm going to sell a 8,500 call option. So let's go to 8,500 call option on 1st of October. Okay. So when I go to 1st of October at 10:15, I see that 8,500 call option was trading at 78 rupees. at 10:15 it was trading at 82 rupees and the super trend was bearish. So it meets my criteria. I will enter the trade. After I entered the trade, I got 82 rupees. However, what happened on 3rd of October, first candle 9:15, which ended at 10:15, the super trend turned bullish. My SL is hit. I will exit the trade. At what price do I exit the trade? At 174 rupees, right? So I made 100 rupees loss, but or less than 100 rupees. In fact, 82, 74, whatever, 19 odd rupees loss. But I will take that 90 rupees loss and I will exit this trade. After I have done that, I will keep on maybe monitoring the MCX chart, and this remains bullish. It remains bullish. Now we see that after the swing high is falling again. If you're an indicator based trader, you will not see this because this is still on a bullish. It may take a support from here, which it took, right? Only when we reach sorry. I was looking at the day time frame. Let me change it to the hourly time frame. The MCX. MCX, clearly you can see that after we had exited, our SL was hit. It was making higher high, higher low. The price was above 20 EMA. The price was above 50 EMA. And only when we reach somewhere on 20th of October, we see that the price is going below 20 EMA and our slope of 20 EMA is also becoming negative. We may like to attempt a covered call here. The price was at 9,400. You saw we saved 100 rupees there on 8,500. If we had not taken a, say, about 90 rupees SL on 8,500 call, you know how much we would have lost? 900 rupees. We would have lost that entire profit. So by taking the SL, we rode this entire movement of MCX from 7,800 to 9,400 rupees. Now we see that it is getting into a consolidation zone. Can we attempt another call option here? We are on 20th of October, 9:15. The candle closes below 20 EMA and the 20 EMA slope is also bearish. We are at 9,404. 20th October. I will again go back to the daily time frame on 20th of October. Okay. And I see that my swing high was at 9617, right? So 9600 was my swing high. So I will attempt maybe 9600 call option or 9500 call option. Okay. And I will see if I can get into that trade. So let's change this option to 9600 because that was the swing high, 9600. So on 20th of October, as you can see, the super trend was bearish. Okay. And we were getting 109 rupees here. And then we have not got an exit. It is trading at 5 rupees, 1 day to expiry. So pretty much from 90 rupees, we made that 90 rupees in the covered call. I hope you got the thing so far, where we are looking at the underlying, we are creating the position. We are first of all trying to avoid the momentum stocks, not doing it at all. But if you're a very active trader, you want to attempt it, then do it at a time on hourly time frame when it is showing sideways to bearish kind of structure. And then you select the right strike based on the day swing high on a day chart. Then you will go to the exact option chart, which is the call option chart there. You will look at the super trend. You will see the super trend is bearish. Only then you will enter the trade. Whenever the super trend turns bullish on an hourly time frame, you're going to exit it. And then you will wait for again the structure to get formed. And that time you will select the right strike. And then that is how you will manage the trade. One additional thing that you can do, particularly if you're a momentum trader and your stocks are in momentum, that you hedge it with a strike which is 10 or 15 delta away, or maybe 200, around say 3 to 4% away from where you have taken your position. So if I had taken 8,500, I had sold 8,500 call option, I would have bought a 9,000 call option in the example. This is an additional step. If you want to do it, because these are the stocks in tiering momentum. Ideally, you should not even be doing covered call. Only if you're doing covered call and you want an additional level of safety, then you can do a credit spread, uh, credit call spread, rather than writing a naked call option. In any case, you please keep an SL and don't shy away from exiting the trade. So net, what I'm saying is covered call is a good strategy. However, you have to apply your logic. You have to manage the trade properly, and you have to do pretty much everything that you do otherwise for any other trade, and follow the steps that I've said. So with that, you will not exit your stock and see it running away uh, like a bullet engine, and miss out on all the gain. So with that, I will conclude it here. A request: if you're watching my video, please subscribe to my channel and also like this video and share with your friends and family. Thank you so much, and I will stop the presentation here. Thank you so much.